Hey investor friends, I'm Michelle Markey and today I'm going to explain what are the 5 main asset classes in order of least desirable to most desirable based on their historical rates of return, and I'm saving the best for last. And when I say that an asset is liquid, that means that it can easily be converted into cash because there's usually a large volume of people exchanging in that, and it can be converted in the least amount of steps. And if you like exercising your money for the most amount of gains, I'd love if you could please smash that like button and please subscribe because it greatly helps out with the YouTube algorithm and lets me know that you're interested in the content I'm making, and I greatly appreciate it. Thanks. First up is cash and cash equivalents, and by default, cash is the most liquid because it's considered to be the legal tender that can be used to assign value for and to pay for things. And because of inflation, the value of the US dollar is declining every year and losing purchasing power. Its real rate of return is negative 1.4% for more than 200 years from 1802 through 2016. And the irony is, even though a lot of people tend to think of cash as being a safe asset, it can give a lot of financial optionality in the short term, but over the long term, it actually loses a lot of buying power. So that's not something you want to hold for a long time. Cash equivalents are highly liquid money market funds that are usually short-term debt in return for some interest on the principal for a short amount of time, usually in periods of a few months to under a year. And these can include items like certificates of deposits, abbreviated as CDs, treasury bills, municipal notes, commercial paper, which are short-term corporate debt up to 9 months, and there are a few other kinds of money market types of funds. And these are considered to be liquid because if someone needs to exchange them for cash right away, they can usually do so, and that's why they're considered to be cash equivalents. Number 2, commodities and alternative investments. And because these are very diverse types of assets with variable rates of return that don't always have long established rates of return, I'm ranking this above cash but below other types of assets that may have more established average rates of historical return. And commodities are tangible assets like gold, silver, copper, crude oil, coffee, and much more. While there are some people who really like owning gold as a hedge against what's going on in the stock market, its real rate of return over the last 200 plus years has been 0.5%, or barely above 0%. And it's not super practical to own gold because how are you going to physically store it and then maybe exchange it for other goods? So it's a little bit of a hassle of a type of commodity to want to have around. And then in addition, some people actually like trading commodities in the form of futures, and this is also known as future contracts or projected prices of what commodities like oil or coffee might be in the future. Trading futures is one type of the derivative category, and what this basically means is a contract between two parties that are trying to bet on the future value of an underlying asset, and this can extend also to equity options or cash flow swaps. Collectibles such as works of art, Pokemon cards, classic cars, comic books, and antique furniture could potentially be considered alternative investments as long as people believe there's value in them. And things like cryptocurrencies and non-fungible tokens or NFTs could also be potentially considered alternative investments. But to me, they're also sort of like collectibles as long as people keep believing that they have value and can be exchanged for legal tender. Number 3, bonds, notes, and bills are part of the fixed income category. And a bond is basically a debt in the form of a loan between at least two parties. And a bond is where someone can earn interest on the debt that's owed to them, but they don't own anything in the company or the entity that's issuing the debt. And with bonds, you either have a coupon paying bond where you have a predetermined amount of interest that's paid at least twice in a year. And this is until the bond's maturity date or the due date, in which you get back the full value of what you invest in the bond. And there's also a zero coupon bond where you buy it at a discount to its face value, and then you get the full amount of the bond's value at its maturity date. There are government bonds and also corporate bonds. The US government issues treasury bills for up to a year or less, treasury notes for years between 2 and 10 years, and treasury bonds usually between 10 and 30 years. And you can also buy US savings bonds at a minimum of $25 and up to $10,000. And corporate debt gets rated by credit rating agencies, and you can usually buy these in your brokerage account in increments of at least $1,000. And if you don't want to buy it in that kind of form, you might also want to consider bond mutual funds, that many of which don't have any minimums so that you can invest in. And some people don't always wait for the maturity date of a bond. They would rather trade them and make money based on changes in the price of bonds, and that's a form of arbitrage. Over the last 200 plus years, US Treasury bills have returned 2.6%, while US Treasury bonds have returned 3.5% in real terms. And these rates nowadays have sunk even lower, where US Treasury bonds at 10 to 30 years are returning between 1 to 2% now. And so what this means that if you had invested for 10 years, $10,000 in a 10-year Treasury bond for 1% interest, you would get after 10 years $1,000 or a total of $11,000. But if inflation is at 3%, you would have lost effectively more than $2,000 because of the declining value of the US dollar. And also, if you would have invested that same $10,000 in stocks at the average historical rate of return of 7%, you would have made 9 times what you would have gotten in the US Treasury bond. So that's just something to keep in mind in how much your bond investments are really returning if you're trying to fight against inflation. Number 4, real estate. And real estate is probably something you're really familiar with, as it's the property in which you live, usually a house or an apartment. And there are other kinds of real estate properties like commercial, which are office buildings, or industrial, which are factories. And unfortunately, this kind of asset doesn't have an easily measurable 200-year rate of return, but I'll talk you through a few examples I found. If you ask most people what is a safer return if you don't need your money for the next 10 years, more people would choose real estate over stocks, per a MarketWatch article. But in the same article, they took data from a Case-Shiller home index and found that the annualized average rate of return of real estate is only 0.4% above inflation. And this might even be worse than gold. So that's actually a surprising stat, to find out that real estate may not really be yielding as much returns as a lot of people make it seem like it does. And that 0.4% was measured from 1890 through 2018, or 128 years. But according to an Investopedia article that also took data from the Case-Shiller index, it measured from 1928 through 2013 to have a housing rate of return of 3.7%, which is surprisingly a lot better than the 0.4%. So let's give real estate the benefit of the doubt, and maybe it yields a better rate of return than bonds these days. You can invest directly in real estate by buying it with cash or with a mortgage loan, as many homeowners do. And people buy real estate for either rental properties, so they might rent out a part of the home that they also live in, or maybe they're doing short-term rentals with Airbnb, or maybe they rent out a house completely or an apartment complex to tenants. That may sound capital and time intensive to commit to, so alternatively, you could choose to invest in publicly traded securities known as real estate investment trusts, or REITs. And REITs are companies that usually own and operate income producing real estate, and you can buy these in your brokerage account, and they're usually sharing their earnings in the form of dividends that some people find attractive. And in addition, there's also a bunch of crowdfunding organizations where you can also invest in real estate, but I'm not very familiar with their investment track record, so feel free to look into those if that's of interest to you. Number 5, stocks or equity, saving the best for last. And stocks or equity are a form of ownership where if you own at least one share of a company stock, then you are a shareholder, and your money that you put into it, or a principal, is your equity in the company stock. And a lot of people tend to think of stocks as just an intangible piece of paper or a stock symbol that they can trade. And while it can be traded, you should think of owning a company as you are a business owner, even if you don't own the whole company, because a lot of people might just want to trade stocks in the company for short-term profit. but you might tend to hold on to your stocks a lot longer if you think of yourself as a long-term business owner and you believe in the future of the company's success. Over the last 200 plus years, stocks had the best real rate of return of 6.7%. So $1 in stocks in 1802 became a little over $1 million in 2016, while cash in a dollar became a nickel over the same period of time. So that's pretty bad for cash and pretty awesome for stocks. And stocks can be liquid if they're in publicly exchanged companies, and they're illiquid if they're in private companies sometimes. And one of the main reasons for this is because publicly traded company stocks can be given a market price every day by all the market participants in a stock exchange. And this isn't the case with private companies. So that's why public company stocks are usually traded at a premium, roughly double that of private companies' value. And private company values aren't usually assessed very often, and usually not until some entity wants to buy it and then offers a buy price for the whole private company. Shareholders can vote for the members of the board of directors, which usually decides a company's management, including its CEO. And shareholders can potentially financially benefit if a company grows and its stock price also grows. And then after some time, a shareholder may wish to sell their shares for a capital gain or profit. And conversely, if the company's stock price declines, then the shareholder may want to sell their shares for a capital loss. Some companies issue dividends that are cash payouts that some people like receiving. However, dividends are taxed at both the corporate and shareholder level. So if a company is able to generate better than average rates of returns on its cash, then it may be better off not giving them out as dividends, because it will help to grow the value of the company in the long run. And we've seen this with Berkshire Hathaway, where its A shares grew from $8 in 1962 all the way to $430,000 in 2021. And these are the A shares of Berkshire Hathaway, so they have the most power. And so we've seen that Warren Buffett was able to better compound the cash that Berkshire generated than if he had given that cash out as dividends to the shareholders. One tidbit to note is if a company files for bankruptcy, then bondholders to whom debt is owed are usually paid first, and shareholders may not be able to extract the value of their investments in a company going through this process. And you can invest in index funds, which are passive forms of mutual funds in major indices like the S&P 500 or the Russell 2000. And funds are just pools of diversified investments in usually stocks or a bunch of other securities. Even though there's obviously risk in investing in all forms of assets, the irony is over the long term, investing in stocks will help grow your money's value, while if you keep it in cash, that will end up being the riskiest move of all. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your investing journey. Till next time.